The 10-year Treasury yield, how to see a recession coming before the headlines do. 1. The warning bell. Imagine a smoke alarm for the economy, and right now, it's beeping like crazy. The 10-year Treasury yield has hit a 16-year high, levels we haven't seen since 2007. And yes, that was right before that recession. This isn't superstition. The yield curve, the graph that maps these rates, has predicted every US recession since the 1950s. Every single one. So what does that actually mean? It means the pattern that always shows up before things fall apart is flashing red again. But before the panic sets in, let's slow down. To understand why this matters, you need to know what these yields actually represent. They're not mystical numbers, they're the interest rates the government pays people who lend it money. Simple, right? You buy a bond, the government owes you back plus some interest. But here's where it gets weird: when people panic and sell those bonds, their prices drop, and that makes the yield go up. So rising yields don't mean good times ahead. They mean investors are nervous. Very nervous. Footnote. The 10-year yield is the economy's heartbeat, and right now, it's racing like it just saw its credit card bill. 2. Bonds and the yield curve. Let's talk about how the yield curve works, because it's the secret decoder ring of finance. Picture a simple graph: short-term bonds on one side, long-term bonds on the other. Normally, long-term bonds pay more, because waiting 10 years for your money back should earn you a premium. That's what a healthy economy looks like, up and to the right. But when that curve flips, when short-term bonds pay more than long-term ones, it's like gravity reversing. Investors are saying, we don't trust the future. This upside-down situation is called an inverted yield curve. Every time it's happened, a recession has followed. So what does that actually mean? It means investors would rather park their cash short-term and sprint for the exit later than lock it up long-term. It's not optimism, it's fear wearing a business suit. Footnote. An inverted yield curve isn't just a warning, it's the financial world's version of yelling fire in a crowded theater. 3. The bond price mystery. Here's the tricky part: yields and prices move in opposite directions. When bond prices drop, yields go up. When bond prices rise, yields fall. It's like a financial seesaw. Investors love this stuff because it sounds complicated, but the concept is simple. If you sell me a $1,000 bond for $980, I'm earning more interest for less money, my yield just went up. So why are prices dropping now? Because nobody wants to hold long-term bonds when inflation is eating cash like a hungry raccoon. If you think your dollar will be worth less in 10 years, why would you lock in a fixed rate today? You wouldn't. So investors pile into short-term bonds instead. That's how the yield curve flips upside down. Footnote. Bond math is simple: panic sells, yields swell. 4. Why yields are so high. Here's where it all connects. The US government has been spending like a college freshman with a new credit card. Massive deficits mean more borrowing. More borrowing means more bonds flooding the market. And when supply goes up, demand, and prices, go down. Investors demand higher yields to make it worth their while. Then there's inflation. The government insists it's under control, but the bond market disagrees. High inflation makes long-term bonds less appealing because that safe return won't buy the same loaf of bread 10 years from now. So everyone moves short-term. The yield curve inverts. So what does that actually mean? It means investors are voting with their wallets, and they don't like what they see. Footnote. High yields are not a sign of strength, they're a neon under construction sign flashing over the economy. 5. The Federal Reserve's hand. Let's not forget the Fed, the puppet master in this drama. Every time it raises interest rates to fight inflation, borrowing gets more expensive. Businesses slow down, consumers tighten up, and bond prices take a hit. But here's the twist: The government itself needs to issue even more bonds just to pay for the old ones. It's like refinancing your mortgage at a higher rate every year and calling it fiscal policy. So what does that actually mean? It means the same people trying to fix inflation are also fueling it, and the bond market knows it. Footnote. The Fed's fight against inflation often looks like firefighting with gasoline. It works, but only for a moment. 6. What happens next? Now, here's the big reveal. History says these warning signs appear 7 to 24 months before a recession actually hits. That's the teach, trust, suggest moment. You can't stop the cycle, but you can prepare. The playbook is always the same: protect your purchasing power. Real assets, flexibility, and awareness beat blind optimism every time. So what does that actually mean? Don't panic, but don't nap through the siren, either. The curve is telling us what's next. It's not psychic, it's just honest. Footnote. The yield curve doesn't predict the future, it just reminds us the future is already being priced in.